You are living through a moment that future historians may mark as a fracture point in the global monetary order. Early February 2026, gold trades near $5,000 an ounce after touching historic highs above that level only weeks ago. Silver, far more volatile, surges, collapses, and surges again, whipsawed by margin calls, policy shocks, and the violent mechanics of leveraged markets. In a matter of days, silver can rise 7%, fall 30%, and recover again. Entire price structures form and dissolve in hours. This is not normal market behavior. This is not a routine commodity cycle. This is a stress signal. What you are witnessing right now is the sound of a monetary system straining under the weight of its own promises. Now we need to talk about what makes this moment different from every precious metal cycle that came before it. For decades, gold and silver moved in recognizable patterns. Gold rose when fear rose. Silver followed later, amplifying the move. Stocks and metals rarely climbed together for long. Bonds and commodities typically diverged. There were rules, there were correlations, there was structure. But those rules are breaking. Today, in many periods, equities recover while gold holds elevated levels. Currencies fluctuate violently without restoring confidence. Real interest rates move in ways that should suppress metals, yet physical demand continues to appear. Central banks continue buying gold at historic levels, with forecasts suggesting hundreds of tons of purchases again this year as monetary authorities diversify away from dollar reserves. Why would central banks buy gold so aggressively if the system were stable? Because they can see what retail investors cannot. They understand balance sheets. They understand sovereign debt trajectories. They understand that global debt has grown faster than the productive capacity of the world economy for decades. And when debt outpaces productivity, there are only three exits: default, inflation, or currency debasement. This brings us to the most dangerous signal of all, the simultaneous rise of assets that should not be rising together. Gold is rising because confidence in currencies is eroding. Silver is rising not only because of monetary demand, but because the industrial system itself depends on it. Solar panels, electric vehicles, electronics, and emerging infrastructure are consuming massive quantities of silver every year, with photovoltaic demand alone consuming over 100 million ounces annually. This dual nature is what makes silver explosive. It is both money and material, both hedge and necessity, and that is why some analysts are now saying silver could outperform gold. Not because gold is weak, but because silver is structurally constrained. Global mine supply has struggled to keep pace with demand for years, creating persistent deficits that continue into 2026. At the same time, industrial demand keeps rising, tightening physical availability and compressing the gold-silver ratio toward levels historically associated with silver outperformance. When shortages meet monetary panic, price movements accelerate beyond what traditional models predict. History shows this pattern repeatedly. In the late stages of precious metal bull markets, silver often outperforms gold because its market is smaller, more volatile, and more sensitive to marginal flows of capital. But to understand the real cause of this phenomenon, we have to step back and look at the system itself. This is where the system breaks. Since the early 2000s, global money supply has expanded at a pace unprecedented in modern history. Central banks responded to every crisis, 2008, 2020, regional banking collapses, sovereign debt scares, by injecting liquidity. Each intervention prevented collapse in the short term but accumulated pressure in the long term. Currencies were diluted to save credit markets. Interest rates were suppressed to stabilize governments. Debt was rolled forward instead of resolved. And now, the cost of servicing that debt is rising everywhere at once. The United States carries debt levels that would have been unimaginable a generation ago. Europe struggles with structural stagnation and fiscal constraints. China faces property sector contraction and demographic decline. Emerging markets wrestle with currency instability and capital flight. In such an environment, metals do not rise because they are valuable. They rise because paper is becoming less credible. Assets are not going up. Currencies are going down. Now we need to talk about global confirmation because the evidence is not isolated. Around the world, ordinary citizens are moving toward physical stores of value. In countries experiencing financial strain, households increasingly turn to gold and silver when banks become unreliable and inflation erodes savings. At the same time, industrial companies are being forced to change production strategies because silver prices have risen so dramatically that profit margins are threatened. When manufacturers begin redesigning supply chains because a metal has become too expensive, that is not speculation. That is structural change. And then there is the gold-silver ratio itself, a signal watched by professionals but rarely understood by the public. Historically, when this ratio compresses toward long-term averages, it often indicates that silver is entering a phase of accelerated performance relative to gold. This is not prediction. It is pattern recognition. Now we come to the contradiction, the lagging asset, the signal that reveals the psychology of the moment. Cash. Cash appears stable. Cash appears safe. Cash appears unchanged. But cash is not neutral in an inflationary system. Cash is a melting asset, losing purchasing power silently, invisibly, relentlessly. Every month that inflation outpaces interest, cash holders are paying an invisible tax. Every currency devaluation transfers wealth from savers to debtors. Every monetary intervention pushes the system one step closer to a reset. And yet most people remain in cash because volatility frightens them more than erosion. This is the psychological trap of every late cycle environment. Fear of movement becomes greater than fear of loss. Now we arrive at the final verdict. What you're witnessing is not merely a commodities rally. It is not merely a speculative cycle. It is not merely inflation. It is a regime change in how value is measured. In previous decades, the world operated on trust. Trust in institutions, trust in currencies, trust in debt markets, trust in perpetual growth. Today, that trust is fragmenting. Central banks are buying gold not because they expect profit, but because they expect instability. Governments are running deficits not because they want to, but because they cannot stop. Markets are rising not because fundamentals are strong, but because liquidity must keep flowing. And silver, volatile, unpredictable, explosive silver, is sitting at the intersection of all these forces. Monetary fear, industrial necessity, structural shortages, currency erosion. That is why some analysts believe silver could outperform gold. Not because gold will fail, but because silver is leveraged to the same forces in a more fragile, more constrained, more explosive way. Time itself is becoming the enemy in this environment. Prices move faster. Liquidity evaporates faster. Crises unfold faster. Confidence collapses faster. And the most dangerous position of all is the one that assumes tomorrow will look like yesterday. Because history does not warn gently before it changes. It accelerates, and then it breaks.